How do you destroy a Wall Street giant in 8 days? On August 11, 2005, this company rang the opening bell and became an overnight sensation. By lunch, the stock was up 25%. 60 days later, it was gone. And the final 8 of those days moved faster than almost anyone could explain, including the people who were supposed to be watching. Refco started small, a commodities brokerage founded in Chicago in 1969, originally called Ray E. Friedman and Company. For 3 decades, it did unglamorous work, buying and selling contracts on currencies, grain, and cattle, one trade at a time. It wasn't always spotless. Over the years, regulators cited the firm more than 100 times for various trading violations, a track record that, in hindsight, nobody outside the industry ever thought to ask about. By 2005, that unglamorous, occasionally messy business had built an empire. Refco was the largest independent broker on the Chicago Mercantile Exchange, handling roughly 200,000 customer accounts and over $4 billion in assets. Its earnings had grown an average of 33% a year for 4 straight years, the kind of number that makes private equity firms move fast. In 2004, Thomas H. Lee Partners bought in, a leveraged buyout worth nearly $2 billion that dressed Refco up for its biggest moment yet, going public. August 11, 2005, 26.5 million shares, priced at $22 each. By the closing bell, the stock is up more than 25%. Refco is valued at $3.5 billion. Financial press calls it one of the best debuts of the year. Nobody ringing that bell knows the countdown has already started. To be clear about what that bell actually meant, for one single day, Refco wasn't just a brokerage anymore. It was proof that the American dream still worked on Wall Street. A scrappy Chicago trading shop, 4 decades old, now a publicly traded, multi-billion-dollar company with thousands of new shareholders trusting it with their money for the very first time. Here's what investors didn't know on IPO day. A meaningful chunk of Refco's success was borrowed from a lie that had been running since the late 1990s. At the center was CEO Philip Bennett, a Cambridge-educated accountant who joined Refco in 1981 and taken the top job in 1998. Colleagues described his judgment as close to bulletproof. That reputation was the whole machine's cover. Years earlier, during the financial chaos of the late 90s, Refco had absorbed hundreds of millions of dollars in trading losses. Some accounts say a chunk of it traced to a single trader's bad bet gone catastrophically wrong, though even that origin story is disputed by the trader himself. Instead of reporting the losses, Bennett buried them inside a private company he secretly owned, called Refco Group Holdings. Here's how the trick actually worked. Just before each earnings deadline, a Refco subsidiary would lend a huge sum of money to an outside hedge fund. That hedge fund would immediately lend the exact same money to Bennett's private company. His company would use it to pay off its debt to Refco, right before the auditors looked. Days later, once the books were signed off, the whole loop would quietly reverse, and the debt would slide back out of sight until the next deadline. If that sounds confusing, here's the plain version. Imagine hiding a debt by borrowing money from a stranger for exactly 1 week a year, just long enough for your accountant to glance at your bank balance and move on. Now imagine doing that, quietly, every single quarter for the better part of a decade. On paper, it looked like a random hedge fund owed Refco money. In reality, Refco's own CEO was borrowing from his own company to hide his own company's losses, on repeat for 7 years. The number moved constantly. At one point, it was $430 million. At another, it swelled past $545 million. By some accounts, it briefly topped $1 billion. By the time the full damage was tallied, investors and lenders had lost $2.4 billion. And crucially, Bennett didn't pull this off completely alone. Refco's outside auditor, Grant Thornton, had already flagged serious weaknesses in the company's books and didn't force a fix. The tax advisor, Ernst & Young, is accused of knowingly preparing tax filings built on the same false numbers. And a partner at the law firm, Mayer Brown, personally drafted the paperwork that routed more than $5 billion through this loop, over and over for years. It fooled, or was allowed to fool, a lot of very well-paid professionals whose entire job was not to be fooled. The weekend before it broke, someone finally noticed. A newly hired accountant, barely 2 months into the job, spotted interest payments that didn't add up and pulled a thread that a small army of lawyers and forensic accountants spent the entire weekend unraveling. Monday, October 10th, 2005, 60 days after the champagne, Refco announces that an entity controlled by CEO Philip Bennett owes the company about $430 million. Bennett is put on leave, and within hours, he actually repays it in full with interest, using a hastily arranged loan from a European bank, secured against his own now worthless Refco stock. It doesn't matter, because in the same breath, Refco admits something far worse. Its financial statements going back to 2002 can no longer be trusted. The money was never really the problem anymore, the lie was. October 12th, Bennett is arrested, charged with securities fraud, and released on a $50 million bond. October 13th, shareholder lawsuits start piling in within hours. A Refco subsidiary that held money for hedge fund clients, including funds tied to a well-known commodities investor holding over $360 million, freezes every account, saying it doesn't have the cash to operate normally. A credit rating agency downgrades Refco's debt straight into default territory. And behind the scenes, something faster and more dangerous is happening. Refco's customers are pulling out all at once. Employees start quietly job hunting while the company is still technically open. One trader on the exchange floor said Refco staff were clogging the exits with resumes. This is what's called a bank run. Refco wasn't actually broke yet. It just didn't matter anymore because nobody believed the numbers, and belief was the entire business. October 14th, customer accounts that held $7.5 billion days earlier have shrunk to about $3 billion. More than half the company's business evaporates in under a week. Rushed bankruptcy paperwork claims $49 billion in assets, a figure so large it would have made this one of the biggest bankruptcies in American history. But it's later quietly revised down to $16.5 billion, because at this point, even Refco's own lawyers aren't sure what's real anymore. October 17th, Refco and 23 subsidiaries file for Chapter 11. In the same breath, a buyout group agrees to pay $768 million for the one part of the business still worth saving, the piece actually built on real trades. October 19th, trading is halted. Refco is delisted from the New York Stock Exchange for good. The stock that opened above $28 a share is worth less than $1. 8 days start to finish. 60 days from IPO to nothing. It's tempting to tell this as a Wall Street farce, but behind the headlines were 200,000 frozen accounts, employees who'd celebrated their IPO days before losing their jobs, and everyday investors who bought Refco stock on October 10th, believing the fundamentals were sound, now holding shares worth pennies. In 2008, Bennett pleaded guilty to 20 federal counts and was sentenced to 16 years, ordered to forfeit $2.4 billion. He wasn't sentenced alone. A business partner got 10 years of his own, and the Mayer Brown lawyer who drafted the paperwork was convicted too. Refco's auditors and the banks who took it public eventually paid out more than $422 million to the investors they'd failed to protect. This was never really a story about one man. It was a story about how many well-paid professionals it takes to not ask an obvious question for 7 straight years. There's a bitter irony buried in the timing. Congress had passed the Sarbanes-Oxley Act in 2002, specifically to prevent exactly this kind of accounting fraud. Refco went public and collapsed 3 years later anyway. In 2020, citing his age and health, a judge granted Bennett early release. He was deported to Britain, a free man. And the surviving piece of Refco, the profitable business everyone raced to save, it was bought, renamed, and eventually became a company called MF Global, which collapsed again in 2011 in a scandal all its own. Some businesses don't just fail once, they teach the next owner nothing at all.